All right, guys, I think we'll go ahead and get started. I think we got most people that are getting on. I think most people are in, so we'll get rolling here. So to everybody in the call, thanks for joining us again. I think a lot of people have already been a part of our quarterly update Zoom meetings, but anyone that's new, we welcome you as well. This is obviously our first of the year, January 27th, 2025. And similar to other meetings, it's a look back at what happened, in this case, in the fourth quarter of 2024, and then a look forward into 2025 and see if we can get our crystal ball dusted off and tell you what's going to be happening here in the year to come. So on the call today, as normal, you've got me, Brian Reese. And then we've got Ryan Ironman and Scott Jones, all certified financial planners with Raymond James CKE Financial Services in Westlake, Ohio. So again, hopefully for any clients you visited us here, anybody that's not yet a client, you can check out our website, check out our LinkedIn page, and then give us a call if you do want to come in and meet with us at some point. Overview of services, just a reminder, we manage 401k plans, about 75 corporate retirement plans, and we work with individuals, foundations. So we do individual planning, personalized, customized financial plans, and meet with individuals that are part of 401k plans, quarterly reviews with our 401k plan sponsors. Our goal is to make sure that we're servicing all clients in the best way possible. So whether that's a 401k plan sponsor or an individual. And for individuals, we do have, hopefully you've all seen this, the written service plan that we came up with in 2024, just to kind of formalize our process on the individual planning side of things. The agenda for today, market update. I'll take you through the market update, key themes. Turn it over to Ryan. He'll talk more about the stock market, looking back, looking forward. Scott will handle the bond market. And then reminder at the end, as we always do, of diversification and some of the tools that we use or have clients use to help in that process and assessing how much risk they should be taking. So let's jump in here as far as our key themes. And really, again, this is not a new looking page, but every quarter this is updated. And we pull a lot of information from our home office team, our chief investment officer, our chief economist, and come up with these themes that we collectively at Raymond James are looking at. And sometimes it's only 3 or 4. This one, there's a lot more to it. And we do bring this as one of the pages, whether it's a 401k plan review or a personal financial planning meeting. We'll oftentimes bring these pages as well, just, for any clients, you may have seen something like this already in person. But what are we looking at? What are we thinking about? Number one is Trump 2.0. So as everyone knows, we're in the second go around with Trump, and some of the things that we're keeping our eye on are, and some of the talk is already out there, and some of these things are already playing out. Tariffs, he's talked about tariffs for a while. There are deadlines set for some of the tariffs. So we're keeping an eye on that. And importantly, what does that mean to the economy and how does that translate into the stock market? And are tariffs going to be inflationary like people usually think, or how is that all gonna play out once the tariff percentages are set? So that's on our radar, something for us to keep an eye on. The other things, budget reductions, tax cuts, the appointing of some of the key personnel in cabinet for Trump, those things are all in motion to a certain extent. I know there's been a shakeup in the DOGE process with the 2 guys running that. So it's one of those reform things that is always going to be in flux, I think, or always changing. So all things that we're keeping an eye on with the new administration and just seeing how it's going to affect the market and ultimately affect you guys, our clients, and your investment strategies. Second one, uncertainty is dead. Long live uncertainty. So remember, the Federal Reserve has a dual mandate, and that's managing inflation and full employment. So we're really, I'd like to say that everyone that wants to have a job has a job mostly. So we're pretty much at full employment. So strong employment numbers. And inflation it's come down a lot off of where it was. The target for the Fed is 2%. So they're not quite there yet, but it's getting closer to that target of 2%. So continuing to watch that. And then as I was saying with tariffs, how that impacts inflation. We'll keep an eye on that, just as our economists will, along with the deportation of people, which has also begun. I'm sure everyone's seen the news recently, even your local news. Whoever's in Cleveland, there's been some local reports of ICE agents out there rounding some people up. So the wheels are in motion on that, and we'll see how that all plays out for us over the next 3 months, 6 months, 12 months. Resetting equity expectations. We've really, if everyone sits back for a second and thinks back, we've really had a really good run in the market over the last few years. In the last 2 years, we've been up close to 25% on the S&P 500. Ryan will talk a little more about it in his section, but strong 24, strong 23, 22 was terrible, but 21 was good. We've had a lot of good years recently. The resetting equity expectations is really about the expectation being more normalized growth. The S&P typically returns about 10%, so we're thinking more normalized growth for 2025 in the 8 to 10% range. Nothing wrong with that. That's very normal, but a much more normalized return as to what we've seen over the past couple of years. Skipping down a couple, but bites and barrels, energy market shifts. So this is that bullet point is talking about oil, the price of a barrel of oil. More importantly, I think the continued conversation about U.S. electrical demands, power demands based on this AI trend that we've been seeing, and all of the data centers that they need to add to power this whole AI push that we've got going on. So the expected demand in the U.S. for power is going to continue to grow by 2 to 3%. I think a lot of these, when you take a step back, a lot of these are just a reminder to diversify. And we're not here to say we're going to pick an energy stock to invest in, but it's a reminder that diversification is still key, and investing in the Magnificent Seven, large cap, but also making sure we're diversified into other asset classes as well. And then uneven growth in an uncertain world. The U.S. market has outperformed international markets for years and years and years. We expect that to continue this year, that the U.S. will do better than international investments. So not much of a change there in the expectation. Still important, though, to diversify and make sure that we've got a smaller portion now in international investments. And for any clients in what we refer to as our freedom portfolios, this is a general statement, the freedom portfolios had a pretty good run because there is lighter holdings in international investments, more towards the U.S., which has helped. Thankfully, it's helped out returns for a lot of our clients. And, sorry, went 2 up. Fourth quarter returns, as we look into this middle section here. So just fourth quarter, the Dow Jones pretty much flat, positive or up 0.5%. S&P was up a little over 2% in the fourth quarter. NASDAQ was up 6%, and then the international index was down about 8%. For the year, 12-month return, the Dow close to 13, the S&P was 23.31 on the year, and really December pulled that back a little bit. We may have been closer to 25% if December wasn't a down month like it was. And then the NASDAQ finished up close to 29%. International on the positive side, but just about 4%. 30-year mortgage rate hasn't really changed all that much. So 6 6.75% or so. You know, it was higher a year ago, so it's come down a little bit, but still much higher than what we were used to. And if you refinanced back in the heyday of it, you know, you might be locked into a 2.5–3% mortgage. So if you're moving now, you're jumping yourself into probably a 6 to 7% interest rate. So I think that's a little bit of a shocker for some people. As you can imagine too, last year for a good portion of the year, when meeting with clients, we were talking about the election, whether it was somebody loved Trump, hated Trump, loved Harris, hated Harris. Regardless, though, the conversation was still the same, that staying the course was the right course of action for most, if not all, clients. And in this slide, this goes back 90 years or so, back to 1932. And the S&P, just the S&P, the returns after the primaries. So the first, if you can look at this, the first 5 months of the year during the primaries versus what happens in the 12 months after the primaries. So since 1932, the S&P has gained on average 11.3% in the 12 months following the primaries. So end of May, 12 months after that until the start of May, on average 11.3%, compared to just 5.7% in non-election years. So part of that, my thought, and part of that is leading into the election, maybe some excitement. There's definitely uncertainty, which is not favorable for the market normally, but uncertainty leading into the election, and then excitement, like this year, excitement around the election. November was a good month coming off the election, calmed down a little bit in December. But if we follow the normal trend, this is telling us that we should continue to have a nice run into 25, and even at least into the start of 26. So 11.3% is the average return since 1932, following the end of the primaries in May. So that's just a little background of where we've been. And then this is the sectors. So again, not telling you to go out and invest all your money in energy as an example, but just shows you the impact of 1 year after the election, how different sectors of the S&P 500 actually performed. I mean, the big one that jumps out at us is energy. So the dark blue is 1 year before the election. The light blue is 1 year after the election. Black dot is the average return. So yeah, energy jumps out at us as a big, much larger return post election, 1 year after the election. I mean that one. What we may see, given Trump's policy on energy, again, no crystal ball, but what we may see is something similar if drill baby drill is actually a thing, and we open up for more of that. We may see growth similar to the norm. Some things like consumer staples, pre-election, post-election, not clearly, no movement, pre versus post. Financials have done really well typically after the election. A number of things, but those two jump out at me the most. Healthcare, a little bit more moderate than I would expect. Industrials, slight increase. Information technology, decent jump up. What we're also expecting, before I turn it over to Ryan, what we're also expecting in the new year is, as I said, moderated returns, but typically with lower interest rates, smaller companies should do better as they start borrowing more money at lower interest rates, reinvesting in their business, working on growing. We would have thought last year we would have saw more growth in small and mid-sized stocks and small and mid-sized companies, but we are thinking that may be, again, it's part of the diversification story, but it may be part of a bigger part of returns in the upcoming year. So with that, I'm going to turn it over to Ryan to let him talk a little bit more in depth on the stock market.
All right, thanks, Brian.
Yep.
Oh, so yeah, so this slide gets into a little bit more of the long-term history of US stocks in particular. Um, and really over the entire span of the S&P 500 going back to as early as 1926, US stocks have averaged about 10% uh, annually. Uh, but very rarely does the actual annual return equal exactly 10%. And this chart kind of illustrates that pretty well. For example, in 2024, we had a return of give or take uh, right about 25%, um, which would be considered a great year. Anything above of 20% or higher is considered a great year. And we had, as you can see on the right, 38 great years since 1926. And then if you look over on the left, in the red section there, we've only had 6 years where the annual return was less, was actually negative 20%. So the point is, over the course of that span of time, the S&P 500 averages right around 10.4%. So this is really a great testament to uh, just keeping a long-term mindset with investing in equities and particularly US stocks. So moving on to, again, one of our favorite slides. I'm sure you've seen this one multiple times, but this is the S&P 500 returns going back to 1980. Gray bars on the top are where the stock market finished for the year. Red dots below that are the low point of the market for the year. So as you can see in 2024, if you exclude dividends, we finished the year at about 23%. And then the low point for the year was -8. So another great reason to consider long-term investing. Going back to 1980, the average low point for the year is 14.1%. And despite that, the stock market finishes positive over about 75% of the time. So moving on here, PE ratio stands for price to earnings ratio, if you're not familiar with that. The way to think about it is kind of the price of the US stock market relative to the earnings generated. So for example, if you have a very high PE ratio, basically that means that the stock is priced highly relative to the earnings. Like you could say it another way, it's highly valued or overvalued. So if you look at the 30-year average of the PE ratio, sits right about 16.9%. And then if you look at the year-end 2024 PE ratio, over on the right, it's about 21.5 multiple there. So we like to use this chart as kind of a way to gauge whether the stock market is kind of hot or cold at a particular time relative to the average. So right now we would say that the stock market is maybe a little bit overvalued with that 21.5 multiple. And we're not saying that trend won't continue, but we're just noticing that the stock market as a whole is a little bit overvalued. And then last slide here before I pass it off to Scott. This is our investment strategy team's prediction on where the S&P 500 is going to finish up for 2025. As you can see over on the left, our base case for where the S&P will finish up is 6,375. A couple reasons we have for supporting that theory is it seems like the economic soft landing that the Fed predicted is starting to pan out pretty nicely. We're still expecting 2 rate cuts in 2025. which should help continue the trend with equities. And then we're still seeing good inflation numbers, and they're moving in the right direction. And then on the right, a couple of reasons why we think that 2025 might be a slightly slower year than prior years, but still positive. If you look at the top on the right there, average performance in the third year of a bull market. So we're thinking that we're going off of 2022 being a pullback. We're expecting a slightly slower year this year, and then average performance following 2 straight years of 20+ gains is 8%. So 2023 and 2024 we had 20+ So another reason to kind of support a slightly slower year, but still strong. And then with that, I'll pass it off to Scott, and he'll talk about bonds and interest rates.
Great, thanks, Ryan. So Ryan kind of went over the stock market performance. We've had some very good equity returns over the last couple of years. We've been kind of patiently waiting on the fixed income side for your bond investments, but this is kind of a similar chart that we used for the stock market returns. This goes back to 1976, and as you can see, the returns are a lot less volatile, largely positive, 44 out of 49 years that this provided a positive return. There's the drawdowns each year average 3.5% drop, so it's very conservative investments. And typically we hold these as, if you have a more conservative risk tolerance, or if you're getting closer to retirement potentially, or getting closer to selling some of your investments, we want to protect those investments. But the average return here is about 6.5%, 6.6% a year. We fell short of that last year, just up 1%. And a few years before that, 2022 was the year that we had the big increase in interest rates. We'll look at that next. We do expect 2 rate cuts this year, and we would expect that as rates go down, there's an inverse relationship. Bond prices will go up as rates fall. But longer term rates have remained relatively sticky, 4.7%. So we're really looking to see inflation come down for those longer term rates to start to come down with that. And so when you hear about rates dropping, but we also have 30-year mortgage rates at 7%. Some of those longer term rates have yet to come down, so that's what we're kind of waiting on, to see happen. Here's kind of the interest rate outlook. This kind of shows you that we had that big spike up in 2022. That was when we had that really hot inflation. Some of that was after the pandemic and the stimulus. We've seen short-term rates start to come down, and the expectations are for that to continue for the next couple quarters, couple of years here. So we do think Raymond James, I know Brian mentioned it at the beginning, there is a favorable outlook for fixed income, and it's been a while. We've had to have some patience, but it's a good time to be diversified for sure, especially if you're getting closer to having liquidity needs. You need to sell some 401k dollars for retirement, what have you. It's a good time to be considering diversification. Here's just a look at different asset classes over time. And this goes back to 2010 to 2024. So over on the right here, you can see large US. The green box is large. It's usually what we refer to as the S&P 500 index. It's large US companies. It's been the best performer for the last 2 years consecutively. And over on the far left, that is the average annual return of close to 14%, which has been the best over the last 14 years. So it's followed by small caps, real estate, and then this asset allocation, white box, 7.2% average yearly return. That's what we refer to as sometimes as a balanced portfolio. It's simply a 60% stock portfolio, 40% bonds, international, different types of stocks and bonds, but really a 60-40. If you ever hear somebody talk about a balanced portfolio or 60-40 portfolio, that's what they're referring to. And you can see it's a much smoother way to invest over time, and you're not going to get all the return of the market, but you're never finishing at the bottom, as the worst performer in any year. So that's what we talk about: diversification, spreading your money across all asset classes. Things like commodities had a really good year in 2022 when we had really high inflation. But if you look actually over the last 14 years, commodities have had a negative return over that whole time. So that's very difficult. Cash is now paying about 4% on savings, CDs, things like that. But for the longest time, it was zero or next to zero. And so you've really been rewarded for taking on risk over the last decade plus. So if you're not sure of which portfolio you should be in, or if you're properly diversified, we have a lot of strategies inside of 401k plans. If you're an employee of one of our 401k plans that we're involved with, that we have risk-based portfolios as well as target date funds that will help you kind of reach that appropriate diversification. We also have questionnaires that we walk employees through to make sure that they're, as they're getting older, they're taking appropriate risk. Maybe their situation has changed, they've gone through a life event, and maybe their risk tolerance isn't the same as it was before. So always good to periodically recheck whether your investments are invested appropriately. I would say it's definitely a good time right now after coming after, basically 2 very positive equity years. You might want to take a look and make sure your portfolio might need rebalanced, bringing it back to the appropriate mix. So with that, I'll pause here with some of our contact information. Feel free to reach out to Brian, myself, Ryan, Tim Ironman as well. Happy to set up a in-person meeting, a virtual meeting. We're doing a lot of Zoom meetings just like this, where we can look at your information, go through some type of financial planning with you and kind of make sure you're in the right place with your investments. So just a couple of disclosures. You always like to include compliance like those. And we'll wrap up. We encourage you to follow us on LinkedIn. We also have a lot of newsletters that you can reach out to us if you'd like to get. I know we send out a weekly market update. If you're not receiving those, feel free to shoot us an email and we can get you included on that. We also do these quarterly webinar calls that are also posted on YouTube following the recording. And if you have any questions and want to refer back to it, please do. So with that, I'm going to close this out and appreciate everybody taking some time with us on this Monday afternoon in snowy Cleveland. But we're halfway through winter and we're looking forward to the sunshine and some warmer weather. But markets have performed well. If you have any questions or concerns with anything that we've covered, please reach out to us and we'd be happy to help you. All right. Thanks, everybody.